Let us start with the term GAAP. Generally accepted accounting principles. It is a set of conventions, rules, and procedures which define accepted accounting practice. GAAP is generally associated with a region, like we have US GAAP, UK GAAP, India GAAP, and so on. In every country, there are certain set of rules and regulations, procedures, conventions, practices that define the way accounting has to be done. Why general acceptance is required? For the simple reason, meaningful comparisons between the firm's past financial history and financial information of other enterprises can be done. If only we have a level playing field, if only we have a common set of rules and regulations, comparisons are possible. Otherwise, every organization will prepare its own accounting data in a different way, and meaningful comparisons won't be possible. So let us learn the concepts and conventions which are a part of this GAAP now. We have around 10 concepts and 4 conventions to learn. In this module, let us learn the 10 concepts alone. In the next module, we can go for the conventions. So when we say accounting concepts, they are nothing but the assumptions based upon which accounting is done. So when we say concepts or assumptions, what are they? 1. Entity concept, also called separate entity concept or business entity concept. 2. Dual aspect concept. 3. Going concern concept. 4. Accounting period concept. 5. Objectivity concept, also called objective evidence concept. Money measurement concept. Cost concept. Matching concept. Revenue recognition concept, or also called realization concept. And finally, accrual concept. Now we will take up these one by one. Learn in brief what are they. Before even I get into the details, let me explain one basic fact here. This topic called concepts is studied twice. One in the very beginning, like now, what are we going to learn? In brief. And later, in most of the chapters in accounting, we will be revisiting this. To give you an example, we will revisit the third concept, going concern, in a chapter called depreciation. We will revisit the 8th one, matching concept, in a chapter called adjustments. So today we are just learning it for the first time in brief. The real learning will happen over a period of time across various chapters. If only I introduce these concepts today, you will be able to recollect it later. So I am going to introduce it now today. And if only I repeat all this in the individual chapters, you will be able to understand the relevance of this or the significance of this. So now let us go one by one, see what are they. So the first one, entity concept, also called separate entity concept or business entity concept. It says, owner is different from business. They are two different entities. They are two separate entities. What is the meaning? Owner may invest capital and start a business. But for accounting purposes, we are going to differentiate owner with that of business. A simple question, are you going to prepare accounting books for owner or for business? We are going to prepare for business, not for owner. Meaning, every transaction has to be seen from business angle, from business perspective, not from owner's perspective. Never bring in the personal activities of owner to the business. One owner may have 10 businesses, but every business will have its own set of books. And never connect one business with another or the owner's personal activities with the business. So to repeat, owner is different from business. They are two separate bodies, two separate entities. And we are going to prepare accounting data for business and not for owner. So in our very first chapter where we learn accounting equation, then we will move on to journal and so on. We will revisit this concept. The second in the line, dual aspect concept, which says there are two aspects in every transaction. For every give, there is a take. For every coming in, there is a going out. Let me give you some examples just to make things clear. Assume you buy 10,000 rupees worth of goods. 10,000 rupees worth of goods coming in, 10,000 rupees cash going out. These are the two aspects, something coming in, something going out. Assume you sell 1 lakh rupees worth of goods. 1 lakh rupees worth of goods going out, but 1 lakh rupees worth of cash coming in. These are the two aspects. Then you may wonder, if I do credit transaction, what will happen? I just sell goods on credit. I don't receive any cash immediately. Then where are the two concepts here? Please understand, 1 lakh rupees worth goes out. Yeah, 1 lakh rupees worth cash is not coming in, but the eligibility to receive cash comes in. This is the second aspect. So, I repeat, 1 lakh rupees goods goes out. Eligibility to receive 1 lakh rupees comes in. And maybe after a week or 2 weeks when you receive the cash, 1 lakh rupees cash comes in and the eligibility goes out now. Because you have got the cash, you no more have the eligibility to receive it. So this is what dual aspect is, and this is the basis on which the entire accounting is built. In fact, there is a concept called double entry bookkeeping, which stems from this, which comes out from this basic concept called dual aspect concept. So the next one is the going concern concept. It says business will be going on forever. The simple assumption here is we don't have any intention to close down the business in short run. We are running the business with a simple assumption that it will be going on forever. Why do we require such an assumption? If we don't assume this way, what will happen? There are many expenses in the business which will be incurred today, but you will enjoy the benefits over a period of time. So unless we assume that we are going to run the business forever, we won't be able to spread this cost over the useful period. It is wrong to treat the entire amount as expense this year, but use it for, say, another 4 or 5 years. When we use it for another 4 or 5 years, it is ideal to spread this cost. But unless we assume that we are going to run the business for so many period at least, how can we spread it? That's the reason why this going concern concept is so important and relevant in the business. Later, when we study chapters like depreciation, we will revisit this concept. The next one comes accounting period concept. There is a time period over which we need to do the assessment or performance evaluation. If I say we will be running the business forever, then when are we going to evaluate our performance? Is it after closing down the business? Are we going to evaluate? Probably not doing evaluation itself will lead to closure of the business many times. So when are we going to evaluate ourselves? Long back when businesses were discussing this particular issue, everybody had their own view on when to evaluate. Some said we will evaluate once in 6 months. Some said once in a year. For some, 2 to 3 years will be ideal. So everybody had their own views on it. That is the time government came into the picture and very clearly said, let us have a 1 year time frame for evaluation. Now came the next problem. When you say 1 year, some said we will start from Diwali to Diwali. Some said we will start from Shankaranti to Shankaranti. Some said we will start from July to June. Everybody again had their own view. So whenever people are confused, it is the duty of the government to bring in clarity. So government said, let us have a common 1 year time frame starting from April 1, ending with March 31st. That is how we got this accounting year or financial year, April to March. So when things were moving on well, many felt waiting for 1 year for results is a bit too much. So they requested government, can we do the evaluation half yearly? So government said we will go ahead, and that's how we got half yearly closing from April 1 to September 30th, again October 1 to March 31st. But even though we close the books of accounts every 6 months, we have to give a complete 1 year report called annual report at the end. But later by 91-92, when we started opening up our economy, when foreign players started coming here, they have a practice of closing the books every quarter. So when we close every 6 months and our own competitors from abroad close every 3 months, there is no level playing field in it. So we also started moving towards quarterly closing. That is how nowadays you find every quarter results are being declared by companies. So is it annual or semi-annual or quarterly? We should have a common time period to evaluate, and that is what accounting period concept says. The next in line is objectivity concept, also called objective evidence concept. Objective means true and fair. Evidence means proof. So every transaction should have a true and fair proof. That is why in organizations, no transaction is considered as valid if it is not accompanied by a valid document. You spend money, there should be a voucher attached to that. For any transaction, there should be a bill or a receipt or an authorizing document like voucher signed by the superiors or seniors. The simple logic behind or the reason behind is, owners stay somewhere. It is a group of management experts who run the business, and the organization will have multiple branches and thousands of employees will be working. So how to keep a check, how to keep a control? When auditor checks the accounting books at the end of a period, he will look for the accompanying legal valid proof. If any transaction is not carrying that, auditor will not accept it. Thereby, there is a check on what is happening, who is authorizing, and whether he has the right to authorize, and all those are set very clear. So objective evidence concept is so important in business. The next is money measurement concept. Only those transactions that can be measured by money will be recorded in accounting. So if you can't measure anything by money, you can't record it. As simple as that. In the very beginning, if you remember, we differentiated financial transactions with non-financial transactions. Only those that will influence or create an implication in the financial position of the business will be recorded. All others will be ignored. Yeah, it is a bit controversial. At times it is also a limitation of accounting. Employees are the biggest assets of the business, but unfortunately they never get recorded because they can't be measured by money. That is why whenever employees are appointed or even CEO is appointed in the business, they never get recorded in the business. But when you pay them the salary for the first month, it comes into picture. Why? Because we can measure it with money. The next one is cost concept. Transactions are recorded at the original cost at which it was incurred, and it remains the same in the data, even when the market value differs. The simple meaning, the original cost at which the transaction was entered into forms the basis of accounting. We never go by market value because it keeps changing. Moreover, market value makes sense when you sell a particular item. As long as you hold it, market value has no meaning. What cost you paid matters. That is why the cost concept clearly says the original cost is the basis. Market value is never an issue. At the same time, you should know original cost will remain as the basis. It will never remain the same. Why? Because there are certain assets which will suffer depreciation. So from the original cost, you keep removing the depreciation. That's why I keep on repeating, original cost will remain the basis. From there, all the deductions will happen. Now let us move to matching concept. The income and expense of the business should be matched or compared for the same time period so as to calculate the profits. Meaning, the income or expense of the previous periods or subsequent periods should not come into picture. Suppose I say compute the profit for the year 2015. You have to just take the income and the expense for 2015 and compare so that we get the profit for the period. Suppose I bring in the income or expense of 2014, 13 or the subsequent period, say 2016, 17 and so on, then the profit figure what we get will not be true. Sometimes you may wonder, this is a very common sense or a basic knowledge, why we are explaining this so much. The reason is, in businesses, you will get income and expense of previous periods, subsequent periods, and it will be a total mixture. You have to carefully filter out the previous period items and the subsequent period items so that you exactly get the income and the expense of the said period. That is why this matching concept is so important, and it has a separate chapter by itself by name adjustments, which you will be studying later. Businesses cannot enforce that we will receive or pay only for this year, because there are so many other factors that play a role in the functioning of business. So they will receive, they will pay for any period, but it is a job of the accountant to filter it out. Now let us move on to the next one, revenue recognition concept. It says revenue should be recognized when the ownership passes on. Ownership is assumed to pass on when the physical delivery takes place. It's better we learn this with a simple example. Let me state a few sentences here. Try to visualize them and we will come back to this. Look at this example. Assume on June 1, a prospective client walks in for an inquiry. You also explain him all the products that you have. You tell him the price, the discounts available, any credit that you offer, and so on. After listening to all this, he walks away. The same guy comes back on June 5th and he places a huge order. Very unfortunately, you don't have so much of stock with you. So you request him, give me 2-3 days time. I will deliver everything to you. And as per promise, on June 8th, assume you deliver everything. But unfortunately, he has no money on that day and he requests 2 to 3 days time to make the payment. And as per promise, on June 10th, he gives you the cash. You are very happy because you could sell so many things at one shot to one person. The customer is very happy because at one shot he got everything from you in one place. When you two are very happy, accountant will be terribly confused. His simple question is, so many things are happening on so many days. When to recognize this transaction? On June 1 or 5 or 8 or 10? The answer is very simple. We just now learnt. The day when the ownership passes on, you have to recognize this as a transaction. But when the ownership passes on, there comes the second point, the day when physical delivery takes place. So, June 8th is our answer. Even though so many things happen on so many days, June 8th is the day when the delivery takes place and so the ownership passes on. So, answering the simple question, when will you recognize this as a transaction? Now, coming to the last one, accrual concept. In accrual system of accounting, we don't wait for the cash to come in or go out. If business is eligible to receive or responsible to pay, it is recorded in the accounting books. Let me give you a brief intro to this topic. There are two systems of accounting in the world. One is called cash system and another one is called accrual system. See, when we say cash, if only you receive cash or you pay cash, it is recorded. Otherwise not. But when we say accrual, whether you receive cash or not, whether you pay cash or not, if you are eligible to receive, if you are responsible to pay, it is recorded. And accrual concept comes from that. Just go back to my previous revenue recognition concept. Why we selected June 8th as the day, even though we have not received cash on that day? Because by delivering, by passing the ownership, we are eligible to receive cash. That is why we chose June 8th, even though we received cash on June 10th. So that is where accrual concept stays. You may wonder, when we have not received cash, how can we take it as a transaction? That is why we call it as credit transaction. On 8th, when we do the delivery and not receive cash, we call it as credit transaction. In case if we have received cash on that day, it will become cash transaction. So these are the 10 assumptions or the concepts we need to remember based on which accounting data is compiled. Thank you.